Hey Shane, how's it going?
Hey man, good. I'm here. I'm a little tired, Had the hockey game again last night, so up a little late, but things are good overall. Got the market commentary published last night before heading out to the hockey game, which was kind of miraculous. That's a major undertaking to write and get all the supporting detail and data and analysis done, and then have it proofread and then have it posted on the website. It's just like a lot to do. So every time we get to a new month, I'm always happy to get it on get on the other side of having the market commentary posted and sent out to people. But now it's time to start getting ready for next month's commentary, which hopefully will be out, the 9th or maybe the 12th of June. So anyway, how about you? How you
Perfect.
doing?
Doing well over here. So weather's been great and starting to think summer's showing up. So looking forward to that.
Good.
But
Summer's definitely here in Florida, man. Although it's been dry. We haven't had any rain. There's like hardly any humidity, which has been awesome. But I think my pond out back could use could use a little bit of rain. So
yeah,
the Gators are gonna be upset if they don't get some water soon.
I bet. So, well, for anyone tuning in, today is May 11th. And, Shane, as you mentioned, you got the market commentary out and you hit on some of the recent bank failures in the news there. And, certainly doesn't make me optimistic today. We'll kind of see where everything ends up, but there are some events happening out there that, people need to be aware of, and it's something to consider in the investment plan. But I thought we would just go ahead and kick it off, kind of go through the commentary and let's talk about some of those fundamental factors and also just some thoughts in things that have come to me from either clients or prospects that are wondering, is now the time to invest? What should I think of all this? So I guess with that, why don't we go ahead and dive in?
Okay.
So this first one, Shane, First Republic Bank. This is what number in the string of bank failures now?
Well, it's now it is now the second largest bank failure in the history of the country for the second time this year. So we already had the second largest bank failure once this year, and now we have the second largest again. So officially, we've got number two, number three, and number four largest bank failures in the history of the country that have already happened this year. And believe it or not, the market hasn't wanted to make a new low. So it's pretty surprising. But yeah, First Republic the chart looked terrible. Some
Mm-hmm.
people tried to buy the dip on it and got eaten alive. You can see your friends over here at Farmer Jim at CNBC buying the stock here and defending his purchase. And of course, that right there represents a loss of 100% of his capital. So, just because something goes from 120 to 40, right, and it represents a good value, does not mean that it's automatically going to bounce back to 120. That is not a good strategy. I would not do that trade. For our clients or for my own personal money or anybody else. If you were going to buy there, you would have to put a stop right here, right? I mean, that's what you'd do. You'd say, "Hey, I'm risking, $9 or whatever down to 30." Um, and hopefully you would have gotten out before it went to zero. But I guess technically it's still trading over the counter at 44 cents or something. I don't know how that really works, to be honest. As far as I know, the bank is worthless. The equity is worthless, and J.P. Morgan got, you know, the assets of the bank for whatever they paid the FDIC, and shareholders effectively get wiped out. Maybe that's not technically accurate. I mean, if you go from, let's say, what, 221 down to 44 cents, I think that's virtually zero. Um, I don't know. Can it go from 44 cents to a dollar now? Maybe. I don't really know. Do you know? Do you know what happens? I mean, it's on the pink sheets now, but what do you own if you buy these shares?
I mean, at this point, you own, I guess, part of an entity, but in terms of is the value going to go up? Well, when you're in pink sheet territory, now it's that issue of, hey, it's 40 cents. Look how cheap that is. But if they issue more shares to try and get a little capital, now they dilute you and share price goes down, or it just never even goes up anyways
Yeah.
because
It's
it,
41 cents today, by the way, and it is trading. I just don't know what you're own. Like, what do you even own if you buy these shares? Like, you have a share, cool. So what do you know, is there going to be a shareholder meeting? Is it like all the First Republic banks are now branded JP Morgan? So I guess I'm just not. Maybe it doesn't matter. I don't really care, but I don't know what you would do with these shares. I don't think they get you anything. I mean, maybe you can
Mhm.
sell them for 50 cents. Maybe you can sell them for $1, I guess. I don't know. But as a
Yeah.
long-term investment, it seems like it's not even worth having. I don't know.
And then Shane, I'm curious, the two questions I have are one from the standpoint of just you're a bank customer, what does this mean for you? And then the other side is if you're an investor, how does this look? Are banks on sale right now? Should we be buying banks? So how do you think of it in those two kind of viewpoints?
Yeah, good question. I'll be the first to admit I'm not a financial an analyst in the financials space specifically. There are specialists who know a whole lot more about this stuff than me. But I know my way around a financial statement, I guess. And as far as I know, the clients of the bank, the depositors at the bank will be fine. Um, JP Morgan's a big bank, and if you go into your First Republic Bank today and ask for the money out of your checking account, you'll be getting it from JP Morgan, and the FDIC will share in the losses that were generated by First Republic banks. Investments that they made that are underwater. So JP Morgan got a pretty good deal, and they have certainly enough capital to satisfy all the deposits that were made at First Republic. So I guess as a client of First Republic Bank, um, you're fine. And I don't think there's a whole lot to really worry about there. But as I've been saying for at least a few months now, I don't see why you would have any money over and above the FDIC insurance limits at any bank anyway, especially when you can open an account at a Schwab or even go to treasurydirect.com and buy US Treasuries for your cash. I realize everybody's got to have a little bit of money in checking, you know, uh, to swipe their debit card or to have their auto pay for their landscaping service or or their Netflix subscription, whatever the case may be. People got to have cash, but there's not a whole lot of people out there who need to have over $250,000 of cash available at all times. Certainly, there are companies and probably some ultra wealthy people where spending 250 grand on something is like me buying a cheeseburger. But those people are few and far between. And for those people, if they lost $250,000, for example, it would also be the equivalent of like me losing a cheeseburger to the dog or something like that because I dropped it on the floor and the dog ate it. Like, bummer, but it's not gonna mess up my retirement. Um, so I think everything's kind of relative in those terms. And as far as, an investor in the bank sector, I don't love ETFs because of course in an ETF you're going to get all the good banks and then all the crappy banks. You're going to have some exposure to things like First Republic and you're going to have some exposure to things like JP Morgan. I'd rather just go look at the balance sheets and find the ones that represent less risk and if they're priced correctly, buy those. And so I think a lot of financial companies, banks in particular, are getting sold because people are selling the ETFs and people are just panicking and saying, I don't want anything to do with banks because you don't know which one's going to fail next. And so you get a lot of the baby getting thrown out with the bathwater. And so I think as an investor, if you want to be buying financial sector stocks right now, I think it's a great opportunity if you know how to do the research. And if you don't know how to do the research, I think it's worth learning and going out and starting to read some of the press releases and the earnings releases and the management commentary on the financial statements from the most recent 10Q and 10K and all those kinds of things. So anyway, the information's available for people who want to spend time analyzing it, and I think there are probably some diamonds in the rough, as it were, that can be bought out there today.
hmm
So I don't know. What do you're the one who is a banking analyst. What do you think about it?
Yeah, so I think on that one, from a bank customer standpoint, similar to what you say, I do not want more than the FDIC coverage in cash sitting in a bank. So I'm going to do a few things to manage that. And then I think it's important to separate out the utility of a bank from kind of the investment side. So the utility is, banks, I think of those kind of like the highway system or a road, is that if it's not there, I've got a real problem. So if I'm going to try and just not use the banking system, it makes things very challenging. I can't drive 70 miles an hour on a dirt road with rocks on it. So, I just want the good stability and I want to be able to use that as a tool. And I think part of the issue that's happening now where people are getting concerned is, okay, if JP Morgan went under, for instance, well, they're so big that the government's going to jump in and save them. So therefore, I'm going to maybe not bank with my neighborhood bank that has 5 branches and has a small customer base because, hey, if they go under, nobody's going to notice nationwide, right? I think that's one issue right now where unfortunately that's, kind of politically where you could have an issue is just people starting to say, I'm going with the big banks because they get saved and the little ones don't. But overall, I think it's the government certainly doesn't want that. So they're going to try and just, make sure the FDIC coverage stays intact, which means you as a customer, just make sure you're managing how much exposure you have. And then from an investment standpoint, back to that highway analogy, highways are not cutting edge technology. They're not innovative. They're commoditized. And that's kind of how I think of the banking system. So where you do have some really good values that are being presented through this. And I think that is a reasonably good investment because if you think of it just in terms of if it's at a, valuation that is lower than where it should be now, there's some upside. But if I'm going to invest for kind of the fastest horse in the race, I'm going to be looking more for sectors that have innovation, growth, and I just generally speaking, regional banks, that's not necessarily where you're going to find that. So, kind of my two thoughts on, from a bank customer standpoint, things are probably okay as long as you manage the FDIC limits. And non-investment standpoint, shop around. There might be some good deals, but it's still just not quite the sector that has growth that you might see in tech and some of the other areas where they innovate.
Yeah, I would be all for um adjusting the FDIC and limit for inflation. That makes a lot of sense. If you print a
Yeah,
whole bunch more money and give it to people, maybe you should increase the amount of FDIC coverage to reflect the fact that, $1 doesn't buy as much as it used to. So, yeah, but I don't know what they're gonna do. Seems like 250,000 is a fair amount of money. Um, but at the same time, I understand why that, like, it hasn't changed in a long time. I don't know when the last time they updated the limit was, but I don't think it's been any time in the past like 5 or 10 years. So
yeah, it
I don't
was
know. It's been a while.
2007 or 2008 where it went from 100,000 to 250. So
Is it? Yeah, I'll take your word for it. That sounds accurate, but I don't have any data, so I
I
believe it.
remember because I was working at a bank and I'll never forget seeing interest rates go to zero and the FDIC limit go to that. I had not read about that in textbooks yet. So, I was internship at US Bank and saw that happening. So it was something
Wow,
else.
crazy.
But so then, as we kind of step through, Shane, what's the number one takeaway if you boiled this all down to one key thing? What was in your mind like, this is the real key point of what the message I want to convey? And then, what, or I guess let's just start with that.
Yeah, well, I think that's the number one thing for me is that the government, what do we call them? The spokespeople, whether it's Janet Yellen or Jerome Powell or even Jamie Dimon, the CEO of JP Morgan Chase, they they're all full of crap. That's the number one takeaway. You can't believe a word they say. They all have talking points. They all have an agenda. They're literally trying to talk a bottom into the market or talk an end into the banking crisis into being the case, right? Because the banking system is safe and sound and the crisis is over and blah blah blah, like all the same crap that they've always said. Oh, the mild recession is coming. Like, oh, it's just there's a recession, yeah, but it's going to be mild, don't worry about it, keep buying stuff. don't ramp up your savings, just keep spending money, keep charging that credit card, keep taking on loans, all that kind of thing. And trust me, there's a whole bunch of stuff I didn't get to in this commentary because it went over 3,500 words, and people have a limited amount of attention they can dedicate to a financial commentary. So I try not to make it too long. But I mean, even for people who want to take on more loans, the lending standards are tightening such that not everybody is able to get a new credit card, and not everybody's able to get an increase in their credit limit. And not even everybody who wants to buy a car anymore can get a loan for that car at any rate, let alone a decent rate, right? So I think that's the biggest takeaway. If you, this right here, Jamie Dimon says this part of the crisis is over. Um, I don't know if it's if you scroll down just a little bit there, Kyle, you'll see the chart of Western Alliance and PacWest Bank. So you see that this white line here represents the day where Jamie Dimon said that, and you can see what happened to the stocks right after. They both crashed by 30% in very short order after he said that. They've bounced a little bit, but Western Alliance still down 50% for the year. PacWest down 73% for the year. And I don't know if you want to go over to your trading view charts and type in PACW real quick. But yeah, if you type in PACW and just look at today, look at how it's doing today. So today it is down. Can you remove your mouse? Today it is down 26.48%. Because they came out and announced this morning that their deposits fell by almost 10% last week. Just last week, they lost 10% of the money they had on deposit. So I don't know if Jamie Dimon is just talking his book and trying to buy another bank out of FDIC receivership or something, but I mean, so far he seems to be wrong, which doesn't surprise me because I think he's got the talking points. He's like, he's dealing with the FDIC to buy First Republic Bank out of receivership, and they're like, hey, look, do us a favor when you make your announcement about this, tell everybody that the situation is fine and everything's cool and there's nothing to worry about. So we'll sell it to you. We'll let you win the auction for a very good deal. But we want you to say these things. And of course, Jamie Dimon's going to play ball. He's one of the elites, and so yeah, it's a good deal if you can get it. And all I got to do is say some BS to people. Like, no problem. I do that every quarter. What else is new? So I think that's the biggest takeaway from my commentary is like you can't believe a word these people say. You got to go out and you got to look at the data for yourself, and you got to for to a certain extent you got to throw out what the stock market's doing because again, Mr. Market is manic depressive and crazy, and he's always offering to trade with you at some ridiculous price, and you don't always have to do it, right? Just because the market's going up, and it is going up right now, the trend is going higher. Doesn't mean that everything's cool and we're out of the woods and the bear market's over and the market's just going to rally from here on out. It doesn't mean that at all. So if you look underneath the hood, the car might look beautiful, but under the hood it might be just falling apart, and you might not want to buy that car. So that's the number one takeaway for me is you just don't read the headlines, as we saw in the First Republic chart. CNBC is telling you to buy First Republic Bank right before it goes to zero because it's on sale. That's ridiculous. Don't listen to those people. And the government is coming with the same talking points they had in 2008, telling us about a mild recession right before the great financial crisis or the great recession, whatever you want to call it. It wasn't a mild recession in 2008, 2009. That I think we can all agree on.
Yeah. And I think what's tough is, the talking heads or the government, they need to maintain stability and calm. That's really their job, right? I think it'd be very hard for them to come out and say, we have no idea what's going on. Things can get really ugly here. But what is interesting is that Jamie Dimon, I think it was maybe 6 months ago or so, was quoted as saying there's a storm cloud on the horizon.
Hurricane. He called it a hurricane.
Yeah, hurricane.
Financial hurricane. Yep.
So it's interesting to me that now we're kind of switching and he's saying, well, the worst is over. We're okay. It kind of a, departing of ways from where he was, where it was warning of this hurricane to come and now things are okay. So
Yep.
yeah, it's just challenging. I don't know the political motivations. I wouldn't be surprised, like you said, where, hey, you're going to buy this bank, and can you just tell people it's going to be okay?
Right.
Because maybe
It's like
he,
a mom coming to dad saying, will you please tell your son it's gonna be okay? Just assure him a little bit, you know. And like dad's like, okay, I guess so.
yeah, and Jamie, and who knows, Jamie Dimon might be sitting there going, look, guys, I can't buy every bank out there. What are we going to do about this?
Right.
So you have some words that get thrown out there, and of course, it's kind of just, hey, let's calm down a bit. So
Yeah, I think everybody just needs to practice reading between the lines a little bit, trying to figure out how to do that.
yeah,
Yeah, this next chart's terrifying actually.
yeah, and
Because
this
again,
is
go ahead.
This is one I was excited to talk with you about, and I apologize, it's a little blurry, but I think it hits a few key points. And Shane, if you want to kick this off, I'm sure I have a few questions for you.
Well, yeah, the lines I drew are very clear. You can blame the Mortgage Bankers Association for their weak, grainy chart game. I don't know why they do it that way, but anyway, yeah, this is ultimately it goes back to the fact that banks are failing while their loans are not failing. Like the loans that they've made back in 2008, 2009, people weren't paying their mortgages, so that's why all the mortgage bonds failed. Um, and then banks failed as well. Here, payments are getting made. There's not a ton of foreclosures and bankruptcies happening. It's the banks that are failing, even though their loan books are doing just fine. Um, but I think that I think that might be changing in the near term because, as you see here, 728 billion uh, of real estate loans will mature by the end of 2023, and those are all done at much lower rates. And now those loans aren't getting paid off. They need to be refinanced, right? Like they're not. $728 billion is not going to get paid off this year. The only thing they can do is extend um, extend those loans by refinancing them. And when they go in to refinance them, the banker is going to say, well, cool, your maturing loan is at 2% or 3% or 4%. And today you're going to pay 7 or 8 or 9% for these loans. And the borrower is going to say, well, I can't afford the payments on that. And, the banker might say, well, yeah, I see that you can't afford the payments. So actually, we're just not willing to refinance it at all. And so the banker has a problem of, well, if they don't refinance it, it's going to default, right? Because the money doesn't exist to pay the loan off. And if the banker offers them a refinance at a much higher rate, they know that the borrower can't afford the payments anyway. So the default might not happen immediately, but it's likely to happen, in some number of months when the borrower can't make the payments. So it's a really tricky spot where the only way to save this is by pushing rates back down. And of course, if the Fed starts cutting rates, they're just going to reaccelerate inflation, which is the whole thing they say they're trying to fight against. So we're in a really horrible spot as a country and an economy, and it's all because of all the money printing that has happened. And so, this is why the Fed is called both arsonist and firefighter. Like they're the one who set the fire, and now they're showing up acting like they can put the fire out, and everybody should thank them for their rate hikes and so on. Like this is all a self-inflicted wound, and it hasn't been allowed to really get painful yet. I think that's the only solution in the long run is that a lot of these loans need to default. A lot of companies need to go bankrupt. A whole bunch of banks will probably fail, even some big ones, and they need to not be bailed out, which of course means just total pandemonium for the regular people who have money tied up in these banks, or maybe they live in these multifamily homes that you know they're the bank's going to come and take them over, and I don't know exactly what all that can mean in the future. I don't think anybody does, but it means a lot of people without jobs. It means a lot of people probably do lose their homes, and that it's not something I hope for anyone. I don't want to see people lose their job and their house and be homeless and starve to death. Like I don't want any of that to happen. Um, and so I don't know what the best solution is. I'm glad I don't pretend to know, to be honest. I think the Fed pretends to know and people in the government pretend to know what's best. And every time they come with a solution, it just leads to a bigger problem at a later point in time that somebody else has to solve. So I don't know what the best thing to do is, but I know that what we've been doing is just kicking the can down the road and making the monster bigger and angrier when it finally arrives. And I don't think that's something you can do in perpetuity. I think at some point, one of these generations is going to have to pay the piper and not bail the economy out. And yeah, I don't know. It's really scary, to be honest. It's
Yeah.
scary. It's not a time where I want to be going long technology stocks with reckless abandon. I'll tell you that much.
Yeah, I agree. And when I look at this, the thing that stands out to me most is, so it shows what makes up the kind of composition. So you have multifamily, office, industrial warehouse. And for 2023, the largest segment I see here is, office.
Yep.
And
Office. The red.
if historically, if I asked you, say, 4 years ago, what's your thought there? You might tell me something like, well, people need offices. That's where the blue collar worker shows up, does their stuff. Well, now we had COVID. So with COVID, a lot of these places are trying to get out of leases. They're not renewing. Everybody's working from home, and you see this large amount on the maturities. And I'm just wondering, like, how many are going to even try to find a solution versus just say, you know what, let's just cut our losses, get out.
Yeah,
It
just
makes
leave the
no
keys.
sense.
Leave the
Hmm.
keys for the banker. And then what's the banker going to do with it? Who are they going to sell it to when nobody needs office space? I mean, a lot of these companies are trying to force their employees to come back to the office. And the employees are saying, yeah, thanks. I'll go find a new job because there's 1.6 jobs open for every one person looking for a job. And, at Elevate, we don't make you go to an office. We have an office in Eagle, but not very many people go there very often, right? And
Yeah.
so when we were hiring for our most recent position, um, we weren't limited to Eagle, Colorado. We could hire anybody in the country, no problem. Although I would I recommend against hiring someone in the state of New York because holy moly, is it expensive for them to get insurance and all the other payroll taxes that go along with it. My word, that's not cool. But anyway, we got a great guy in New York, and we're happy about it. So it'll be worth it. But um, yeah, you know, a lot of these offices they're just going to get walked away from. The bank is going to take a giant loss on the fact that they, won't get paid on it. They're going to have to find a new buyer for the office. And of course, with all that office space that's about to go on the market, the prices are going to get compressed. And interest rates are so high that the price has to be lower in order for anybody to afford the payment. And I think a lot of the offices are going to end up being retrofitted into residential housing because there's no inventory of houses for people to buy, assuming they can afford them right now, which is causing home prices to stay elevated. So I think the best thing that could happen is a lot of these offices get bought by, like, say, you know, um, just think of a high-rise office space in Manhattan that nobody needs the office anymore, but people still maybe want to live there.
Hmm.
Well, you can take that office and turn it into a bunch of apartments, but not without a ton of expense, right? Like you don't need you're not going to turn it into a hostel. Maybe you are, right? Maybe you could turn all those cubicles into little bunk beds and keep the same, big public restroom style, and like people who lose their homes would end up moving in there. I mean, I'm saying that jokingly, but like it might end up that something not too far off from that happens. But my point is that it's not free. It's very expensive to take a current office and turn it into a traditional style apartment. Like
Yep.
that money's got to come from somewhere, and so you have to get a discount on the property in order to be able to pay um, for all that modification. So at the end of the day, banks are going to get hit here. Unless somehow rates go down meaningfully. So yeah, I don't know how it will resolve, but it's definitely a little scary to look at.
It
That's
is.
almost 1.4 trillion. It's like $1.387 trillion that comes due before the end of 2024. So in the next, 19 months.
Yeah, so something you can't ignore. We'll see how that turns out. But and then let's see here, going through. So, we've highlighted this in past chats, but just excuse me, some of the central bankers here just saying, hey, gonna be okay. Keep calm. We saw how it turned out in '08. We'll see about now.
Just a mild recession coming, guys. Nothing to worry about.
Yep.
Nothing to see here.
And then this one, you certainly can't ignore. Talking about fundamentals here, earnings growth you highlighted down 8.5% just across the board, so not sector specific. And then was it earnings growth down 3.2%?
Yeah, for the S&P 500, earnings are down 3.23, and for Nasdaq down 8.5. As of today, those numbers have both gotten slightly worse. Nasdaq 100 earnings growth is down about 10%, with I think a little over 80 of the companies reporting. Healthcare was terrible, down 32%. Healthcare in the S&P 500 down only 15%. But notably, technology within both was down 9% in the Nasdaq, and then a little over 8% for the S&P 500. So it's always funny when growth is a negative number. How do you have negative growth? Well, it's not growth. It's the opposite of growth. So it's a little weird on the terminology. Normally there is growth, so calling it growth makes sense. But
Right.
every now and then you get into these times where earnings aren't growing, and they're actually declining. So that's a profit recession.
Yep. And then I'm just going to hit on this really quick, but we've talked about this chart several times, and that's just that, in '08, you still had a rally after Lehman Brothers filed for bankruptcy, and then we proceeded to go down 43%. So
Yep.
a little bit of a
This is
rally
where
here.
this is where I think we are right now. I think we're right
Oh,
in that area. Oh, you keep moving it. But I think we're right there where the Fed's saying, we could be facing a mild recession, and the market just kind of continues to grind higher until it doesn't.
hmm
And so that's where I think we are in this cycle. I don't know. I could be totally wrong. Wouldn't be the first time I was totally wrong about something, I promise. But that's my gut, and that's what my analysis tells me, is that's right around where we are in this cycle.
Yep. And then here we are. We'll just kind of go through and skim these ones, but Bear Stearns headline again. Problem contained when they bailed out a hedge fund. We all know
And
how
then
that turned out.
10 months later. So it was all good for 10 whole months. Think about how much time that is.
Yeah.
From the time Bear Stearns bailed out that hedge fund was June of 2007, and then they didn't fail until I think it was March or April of 2008. And so for that whole time, everybody was like, "Ah, it's fine. Bear Stearns will be fine. It'll be fine. Everything's good. Nothing to worry about." And of course, that wasn't true. And so, if you had started shorting the stock market all the way back in June of 2007, you'd have gotten your face ripped off before the market finally dropped and bottomed. But that's like the movie The Big Short. That's exactly what those guys did. The funny thing about those kinds of trades is that if you waited until the perfect time to put them on, the trade wouldn't be available. You have to be early. You have to first do the trade and be willing to lose money for 10 months, maybe even a year on your trade before it finally pays off in a massive way.
hmm
So like, I know everybody likes to say, "Oh, well, if you're early, you're wrong." I get it. I don't disagree, but there are some extreme trades out there that are not available unless you go early. Like by the time it's the right time to do it, you just can't make the trade anymore because nobody will take the other side of it because it's so obvious. So you got to go early in order to get it done at all, let alone at a good price. So, uh, I don't know what that means for today necessarily, but that 10 months is a long time,
Yeah.
to hold on.
And it's always challenging because one axiom that holds true is that if you buy the market and hold on, it's going to go up in the long term. That's inevitable. But if you can just dodge some of these large sell-offs in the interim and protect capital, you're going to do very well in the end. And we can look at this chart. So Shane, you've kind of got it in here. Not too much to report, just with intraday right now, it's kind of mixed again. But if I look at this technical picture, like you're saying, well, there's a 10-month difference in time with what happened then. And we look now and it's like, hey, we're coming down here. We're above the averages, higher highs, higher lows on the S&P. Why am I not buying here?
It would probably
Kind of
be
what,
good if you could use your drawing tool. I don't know if you know how to do that, but I can see your mouse, but well, not very clearly.
yep, let me grab
When
the,
you say here and stuff like that, I'm just not sure exactly where you're referring to.
so when I come over here, I see, there's a higher high. Here we are again, higher high. And you also have your higher lows that are in here.
Yep.
Everything when I look at this is saying, why wouldn't we just, go up nicely like that from here? But I think that's where the difference in timing comes in is the obvious trade is, hey, if I see all these negative things, I want to go short. But it's never going to be that easy on you. And as long as we're still stuck under this kind of 420 level on the SPY, there's just no reason to even, you can say that we're base building, but do you have to get in early on this trade? I mean, we could go up the next 10 years when it's time. You don't have to get in right now. You can leave some invested, which is a lot of what we do here at Elevate is always leave that core position, but you're just seeing it continue just churn under this level. And I think that's probably one of the most frustrating environments for investors is that they start to look at headlines, they want to get bullish, but every time they do, they just keep getting, stuffed at this level. And anytime you're trying to short it, you're also just sitting here grinding it out. It's just a very difficult market.
Yep, it is. But I like right here where it did not put in another higher high. So it's kind of it's stalled out at least for now. We'll see if it can go sideways and then break out to the upside. But like you were saying, man, you I don't think you need to pick the bottom here. I think you might want to hold on to some good stocks like Google and Amazon look excellent over the past couple of days, and we've been accumulating some shares of those. And we still, we've maintained some core positions, but we got a ton of cash. And if we're really in a new bull market, we will have the next several years to buy on dips as the market just grinds higher and higher and higher to a new all-time high. So there's plenty of upside left when we finally do get out of this bear market and into a new bull market. Maybe that's already happened. Time will tell, but if we are in a new bull market, we got plenty of time to buy dips as the market grinds higher. So I'm not in a huge hurry, and picking the bottom isn't where your success comes from.
Mhm.
Managing your risk is where success comes from in long term. And you said something else too about the market going higher if you're willing to hold on. That's true if you're in the accumulation phase of your life where you are working and you're saving money and you're accumulating stocks. But it's not true once you are retired and once you're taking money out of your investments and living off of that money for your retirement. I don't know if you want to work on clearing your drawings out there, Kyle. There should be a clear button somewhere where those will go away. But we've talked about it and I've written about it in commentaries before that the sequence of returns is important. If you um, if you start taking distributions out of a market as it's going down, those dollars are no longer in the market to recover when the market finally starts going up again.
Mhm.
So just because the market over time tends to go higher, doesn't really mean anything once you're in the distribution phase of your life. Um, the market can go higher and you can still run out of money and still end up living on your kid's couch or something like that because the sequence of returns is such that you failed and you will end up going back to work and things won't be very good for you. So So I would be careful, for people who, are in that type of a situation, that the market might go higher, but if you've been forced to take distributions in the first year and a half of this falling bear market, your portfolio dropped by say 20% because you just bought the S&P 500 and held on, and you were taking money out. So let's say you took 5% out and the market went down 20%. Well, 25% of your portfolio is now gone, and you're only 1 or 2 years maybe into retirement. If you didn't plan for that, you might not make it the next 30 years, regardless of how well the market does, because you need to keep taking money out of that portfolio in order to maintain your lifestyle. So, um, despite the fact that people love to say, well, just buy and hold and, asset allocation and blah, 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 all that goes out the window when you become, a retiree and you're taking money out of your portfolio. There is no such thing as passive investing while taking distributions. Like, it's so opposite from accumulating stocks. It's hard to put into words. Like, there's lots of charts we could show, but it's it's not the same deal. Like, everything about it is totally opposite.
Hmm. And that's the biggest thing is when you're looking at this chart and you're trying to pick tops, bottoms, and all that, it's nice we can sit here and talk about, beating the market, but really it's about that risk management and all the more important later in life. When you're young, it's just like think of normal life. If you're 25, it's okay if you haven't found your job yet, if you haven't found your calling. When you're 55, 65, that doesn't really work so much anymore. And the same goes for how the assets are managed, is that you have to have strong risk management, because now is the critical time where doing that right can make it a worry-free retirement, and time to go enjoy your time with the grandkids or whatever it may be. But just thinking that diversification is going to do it, it's not the best place to be, because correlations change, and that's the central component when you talk about diversification. Bonds and stocks, if you own a mix, you're okay, right? Well, not so much in the last few years. So,
Yep.
and then we'll go ahead and flip it over here, look at the Nasdaq. But this one here, it's just, man, higher. Oh, and need to change my color here. I don't think that's coming through so great. What is it? Let's see. There we go. So on this one, you got the Nasdaq. It's still not quite what we wanted, but it's still just in this channel. It's working higher, but you're not setting any new highs here. I think as long as we stay in this channel, it might grind its way higher, but breaking that channel sets conviction to the lower side or the downside, but we're still kind of stuck under this 334 level.
Yep. I don't have much to add. I don't see any reason why tech stocks are doing so well. They are. It's hard to argue with the fact that they're going up, but I don't see any fundamental long-term support for that. So we'll see how it all shakes out in the long run. But yeah, they're definitely up from their lows and making a series of higher lows and higher highs. So that is usually the definition of the beginning of an uptrend. So see if it can hold on.
Yep. Oh, better get rid of those.
Yeah, there's a clear button in your table. You don't have to use the eraser. There's like just a straight up clear button. Clears everything.
Oh, there. I
I don't know
found
how
it.
much time we've been going on here. We've got to wrap this up here shortly or
Yep.
what?
So I think we'll wrap it up here. And one thing I wanted to just pull up, you mentioned tech stocks. I've got one to bring up we can talk about, but I thought this is important just to hit on again on the fundamental side. But we're now sitting here. We talked about this chart early on we had drawn, but here we are and it's May. And you come over here and Shane, tell me what this number is. It's black. All the others are red.
Yeah, well, it's the first time that the Fed funds rate has been positive on a real basis in a very, very long time. So finally, the Fed is restrictive with their monetary policy and should be slowing down the economy. So far, they've just been less accommodative. Hasn't really been restrictive at all. This to me is my definition of restricting economic growth. Like, it actually costs real money to borrow at these levels because the interest rate that you're paying to borrow is actually higher than the rate of inflation for the first time in a very long time. So that's how, I mean, the Fed should have done that straight away from the get-go a year ago, and we would already be over. We would be done with this bear market. The recession would be over, and we would be, we would be climbing back to a bull market for sure by now. I think that's almost certain. But instead, they took their sweet time, and they didn't want to hurt the market too bad, and they didn't want to cause too much of a shock, and they didn't want to cause a recession, and so on and so forth. And so they were kind of babies about it, even though they were hiking by 75 basis points and 75 basis points and 50 basis points, and then slowed down to 25. Like, they could have just hiked by 2% or 3% or 4% all at once, and we would have squashed inflation immediately, almost overnight. Yes, a whole bunch of people would have lost their jobs. The unemployment rate would have ticked up. All that would have happened. But dude, eggs would be so much less expensive. Like, I wouldn't need a home equity line of credit to buy a dozen eggs right now.
Yeah.
Um, and so, but this is just how it is. Like, that's not how you get votes, right? You don't, by ripping the band-aid off might cause your guy to lose a few votes in the election or whatever. And so, um, I don't know. I think our government is mostly just a bunch of crybabies, and they just never do the hard thing. They just never ever do the hard thing. So, um, I like to do hard things. It makes me feel good when I do them successfully. So, anyway, but this is important. We do finally have a positive real Fed funds rate for the first time in a long time. This should actually begin to slow the economy down, which would, that's why we saw earnings growth as a negative number, right? This is all starting to kind of trickle through. And I think that will give the reason for Fed to just pause the rate hikes and see how much impact even this very slight positive number has on the market. Um, when you're at a negative real Fed funds rate of 6% and 5% and 4% for all that time, a positive 0.825 um, isn't really going to do it, I don't think. Which is why you see inflation begin to tick back up later this year, at these assumed rates of monthly growth. And if that happens, the Fed will have to resume hiking rates in November, December, and so on in order to get back to their 2% inflation target. So
Yep.
we're still nowhere near 2% in any of these projections. And I do think there's some more important stuff in here. If you want to scroll down, maybe just I didn't mean we had to wrap it up right this second. I just didn't know how long. Do you have like a
Nope.
clock that shows you how
I've
long we've been talking for?
Yep. So I've got it. So we're on 40 minutes right now.
All right,
So
so we got like
we're getting
5 more minutes.
towards the end. I've got two stocks I want to show people. So we'll flip over to that at the end, but
Okay.
certainly we want to hit on this.
Um, yeah, more inflation numbers. That's pretty self-explanatory.
And then we have M2, which
Yep, that
that,
was a big one.
oh man, that's a lot of money coming out of the system. That's how I would interpret that, right? A lot of money printing that happened in 2020 and now it's
I mean,
going back.
this has never happened before. Anybody who tells you they know what impact this is going to have on the economy and the growth rates is full of crap. Nobody has any idea. I know what it implies. It implies a major slowdown. Like, if this whole spike saved the economy from failing because we printed and pumped a whole bunch of money into circulation, well, this should have the exact opposite effect. But check it out, dude. This up here is literally year over year growth rates of like 27%, plus 27%, almost 30% more money in circulation from the 1 year prior number right there.
Hmm.
This is only minus 5%. So again, just like the last chart we looked at, it was so accommodative that even this amount of restriction might not have, the exact mirror image effect, if you will. But at any rate, a declining supply of money in circulation is just, it's less dollars. It's less dollars to buy anything, whether it's stocks or eggs or bonds or lawnmowers or whatever. And the less money that's available in circulation to buy those things, the less people will spend. So this is I don't, it's something that definitely has my attention. I don't know what the lag will be, right? Like, I don't know how long it will take for this to materialize in the overall economy and slow down growth. But I think I'm pretty sure that that's what's coming. And I think that's why I think that's why a recession is all but imminent. Just a matter of when does it start, how long does it last, and how deep does it go? That's kind of where I sit. Of course, the Fed could just turn around and start printing a bunch of money and undo all this in very short order, like they kind of did with the banking crisis. Just print a bunch of money and bail people out. So we'll see what happens. But to me, this is the scariest chart in the whole market.
Yeah, definitely quite the exaggerated move. Just look back at, where this chart starts, and now you have this gigantic move. It's a little
Yep,
alarming.
it's ridiculous.
So, and then I think here kind of hit on Schwab and some things going on there, which
If you want
we
to
have.
stop right there.
Yep.
Sorry, I don't mean to interrupt you, but these especially the first one, and you can click on it if you want, Kyle, but I would encourage anybody who has questions about Schwab's financial stability to go click on that here, like Kyle just did, and you will hopefully get a PDF of some stuff that I mostly hijacked from Charles Schwab's financial statements and earnings release, their own deck and stuff like that. So there's just some pretty cool data in here, like 132 billion of new assets they got in the first quarter. So while those banks were failing in March, Schwab took in $54 billion of new assets because as people were fleeing those banks that failed, they sent the money to Schwab, and we saw that happening even from our own clients. So anyway, there's just a bunch of cool data in here, and y'all are welcome to go out to our website, click on market commentary, find this section, and click here to open up that PDF and review it on your own time.
Sounds good. Thanks. And then, go back. So kind of continue on Schwab, and then Shane, I don't know if was there anything left that you wanted to hit on, or
No, I
otherwise
don't think so. I think that'll do it, man. I think the only thing after the Schwab stuff was saying hello to Tom. So new guy Tom finally gonna get added to the website. He made it his 60 days trial period, so I have a feeling he'll be sticking around because he didn't quit on us already. So it's good to have Tom around.
it is. So Shane, I just want to hit with, we painted this story now. Not the most optimistic. So what we didn't do though is, we looked at the overall indexes, but underlying, there's always individual names. And even in 07, 08, you had names that did well. Netflix is one. So when you ask, well, if the macro picture is that bad, does that mean there's no opportunity out there? And, I'll just start with NVIDIA here, but, I'm looking at this thing and it's pretty bullish. I mean, I don't want to come out and say buy now because it has done a bit of its run, but look at this channel. It's just going right up over the averages. So just an idea of what's out there. I don't know if you know anything specific to the stock, Shane, or maybe you've been watching a little bit, or at least the semiconductor space. I know there's that chips bill, but anything there?
Can you right click in here and go to the
Yeah, hold on.
auto fits data to screen. There you go.
There we
Yeah,
go.
so the first thing I would note is that Nvidia is still down 20% from its highs. And before that, it had gone down what? From the peak to the low, it was down from here to here was minus 70%.
Hmm.
Um, so really all it's done is gotten up off the mat, and it's crazy overvalued, it's super expensive.
Yes.
And AI is the new buzzword, man. AI feels like the new .com. Anybody who says AI, and of course, NVIDIA is going to supply a whole bunch of chips for all this new AI stuff. Um, it's a good company, strong company. It's super expensive. It probably doesn't deserve the price tag it currently has. Um, but that doesn't mean it can't go higher and put in a new all-time high. I just think it's crazy. I wouldn't, as an investment, I don't love it. As a trade, fine. You want to buy it and put a stop even at the 50-day moving average because you want to just take a normal size position and just be in it for as long as it holds above that 50-day moving average. Like, be my guest. But you see right here and right here, when that 50-day moving average gets extended away from even right here from the 200-day, like that's what we're seeing right here. It's very extended. Like my guess is I don't know how long this can continue for, right? But even on the downside, same thing. Right here and right here, when it gets extended like that, it usually kind of undoes itself. So I see this more as a topping process and probably a trip back to the uptrending 200-day moving average at some point, whether that's starting today or starting next week or starting next year, after it goes all the way up here first. I have no idea. But I think Nvidia is a great company. I wish that we would have bought it for our growth strategy when it was down here in October, but I didn't. And I what I should have done is bought it right here. That's where I should have bought it. That was, we had a low, we had a higher low, and then we had a breakout right there. And that's where I should have bought it. And if I had bought it there, we would have bought it just under 200, and it's at 85 now, and we would be up nicely. We would be trimming some profits. We would be putting a stop loss probably at the 50-day moving average, and we'd be keeping a whole bunch of our gain. So shame on me for not taking advantage right there. That is it. And I think, Nvidia 10 years from now will probably be way higher than it is today even, but there could be a whole lot of volatility and a trip all the way back to a new low before that comes to pass. So for now, I'm out of the game, and I would not chase it here personally, but
Yeah.
I think you can.
And
All about
here,
risk management, right?
couple things to point out on risk management. We have earnings coming up on May 24th. And oddly enough, and it doesn't mean it has to happen, but you had this high and look at where we are now.
Yep.
Really close to that into earnings. Just not a great time. Doesn't mean it can't go higher, but just not a good time to gamble on that one. So let earnings come out, see what sets up. But just, interesting thing to point out, like one of the names that is doing well. And then, I'll point out one more, and people don't always look at this as much, but you've got all these fun, tech names and all that. Well, here's boring old Hershey. They make candy. Go ahead and move this, but I don't think I even need to be a technician to look at this chart, and I think most would see it is what direction is this thing going? And it's pointed up. So, just wanted to point that out for the idea that you can look at the broader indexes and that gives you an idea of what's going on, but it's always good to look underneath all that. And you can see that even when you have a macro backdrop like we have that is certainly not bullish, there are names in there that still can look good. And, that's where it makes it so hard to just say, hey, I'm going to go all cash and not participate in this market because, as you can see, still some names that are working their way higher.
I would say this is funny because this is obviously an old chart. We didn't draw this line recently. We drew this line back when this was the all-time high, right?
Yeah.
And you'll find a lot of people that say, well, gosh, it's trading at an all-time high. I don't want to buy it at an all-time high. Like if Nvidia was trading at an all-time high, I would feel totally differently. I would be like, you should buy that. Even though it's up hundreds of percent from its lows, it just put in a new all-time high. That means people are willing to pay more for this stock than they ever have been willing to pay for it in the history of the stock. That is meaningful. So look at what happened with Hershey when it put in a new all-time high right here. It did nothing but just send it higher, because now everybody notices like, wow, Hershey's trading at a new all-time high, and it just keeps going up. And so I'm glad to say we've been in this stock for a very long time, and I think we'll probably stay in it for a very long time, because a Hershey bar, the chocolate is never going to go out of style. Of course, that's not all that Hershey has. They've got salty snacks now too, which is providing a lot of their growth, pretzels and chips and this kind of thing. But they own a whole bunch of different candy, as you might imagine, than just the simple old Hershey bar. So I like to ask people a lot, like, will your grandkids rather have a Hershey chocolate bar or an iPad? And usually it takes you a minute to think about it because it's like, wow, my kids really love their iPad. But iPads are like, it's a technology that's eventually, right, they're going to implant that thing into your brain and you won't need the iPad anymore, right? Chocolate never going out of style. I don't care how
Hmm.
many decades or centuries go by, chocolate's still going to be chocolate and people are still going to have taste buds.
Yep,
So I would rather have the chocolate bar than the iPad.
I would agree. So, good to just point that out. Some names that are still doing well and that'll persist throughout time is that there are always going to be some stocks that do well, no matter how scary it looks out there. So, and with that, we can just turn it over, but the government saving money, Babylon Bee here. So you can read the headline here, and now that we're actually on the web page here, people can kind of see the start of what the article is. So
Saving money on bombs. Love it. It's funny that they mentioned obese people. I should have told you to pull up NVO, that stock. They got the weight loss drug and it's just ripping and making new all-time highs too. So that's another market where it's like with so many people who are overweight in the world, this stock is going to just keep ripping.
yep,
I mean, don't get me wrong, there's some regulatory risk there too. Because every time a drug sells that much, you might find out that the government wants to slow it down for whatever reason. But this thing just, it keeps grinding to a new all-time high, like seemingly every month. So something to look out for.
yep. So again, just another name that scary macro backdrop, and stock doesn't seem to care. So
Yep.
there's always some good ones out there. But Shane, thanks for taking your time again today. I know we did a little different format, so we'll continue to tweak this a little and perfect it. So, as everyone knows by now, we're going to switch this to a monthly kind of distribution to have it out there for everybody, and hopefully we'll just refine it more and really perfect what we're doing.
All right. Yep. Like, subscribe, send us questions that we can answer on the next one. Thanks, everybody.
You bet. Have a good one.
See you, Kyle.
Bye.